Right, well, for more on this decision, we're joined by Henry To. He is the Chief Investment Officer at CB Capital Advisors. Henry, thank you for joining us. Good to see you again tonight.
Hello, Michelle. Always a pleasure. Good to see you too.
So, Henry, MSCI deciding against including China AShares in its emerging markets index for now, saying that they would likely do so in the future after several issues are resolved. Henry, what are the main issues?
It's a little bit disappointing, but it's, like you said, it's not surprising. There are two issues that I'm looking at right now that we've been tracking of over the last 12 months that would not allow MSCI to include Chinese AShares. Number one is that when you look at how foreign investors could purchase Chinese AShares, there's no good way for them to do that, to purchase Shenzhen AShares. Now, they can do it if they qualify under the QFII rules, but not many people can do that right now, except for Vanguard and 50 other institutions around the world. So now you really need to get the Shenzhen and the Hong Kong Stock Connect program established before MSCI will even announce it. The second issue is that when you look at the daily quota that foreign investors could invest into Chinese AShares from Hong Kong in the Shanghai market, there's only a $13 billion daily quota. Now, that's not enough to provide daily liquidity. They really need to increase that.
All right, so there's not enough openness in the markets, although the Shanghai Hong Kong Stock Connect has made a significant difference. And as you say, when the Shenzhen Hong Kong Stock Connect is eventually launched, that will definitely open up the markets too. So if you were to estimate a timeline when MSCI may actually make this decision, when do you think that'll be?
I think it's very soon. I think there's a lot of motivation on the part of Chinese regulators to do so. Also because the IMF is right now considering to include the Chinese renminbi currency as part of the special joint rights basket. So in order for that to qualify, Chinese regulators really need to accelerate the process. And so far, they have a really proven track record. In terms of the timeline, I am looking at the end of this year, so pretty soon. And I think it takes time for money managers to adjust to the new index, especially given the size of the Chinese A-share market. So it's going to be the end of this year, and then by June of next year, it'll definitely be a very hot area.
All right, that obviously means you're still very long on the market. Now, Henry, currently MSCI's emerging market index has a 25% exposure to China through Hong Kong listed stocks, or AShares. Why is this viewed differently?
So I think because when you look at how you purchase AShares, like you said, it's very hard to access. It's not very transparent. So among institutional investors, at least in the United States, the only large organizations that I have been keeping track of, aside from the banks, is really Yale, Harvard, a lot of the big endowments. A lot of US investors are not educated on Chinese AShares. It's not a very transparent market for them. So this is a big deal for both US investors and Chinese investors.
Well, you know, regardless of the MSCI's decision, index fund giant Vanguard said that it would add AShares to its funds. FTSE launched last month, said that it's going to launch transitional indices for emerging markets that will include AShares. S&P Dow Jones said it's looking at adding AShares to its emerging market indices by September. So, Henry, what does all this mean? That really the Chinese markets are opening up regardless?
I believe so. When you look at the size of the Chinese A-share market, it's a $10 trillion market, Michelle. It's the world's second largest market, right behind the United States. China has the second world's largest economy. It's going to become the world's largest economy, I believe, in 10 years. So I think it's inevitable that there will be a lot of exposure. There will be a lot of need to invite foreign capital to the Chinese A-share market, and also because it allows companies in China to more easily raise money. So I think it's inevitable because of the basic math.
Henry, you say it's inevitable. One thing that I want to ask you, is a bubble inevitable at some point here, or are you not worried about that yet? The Shanghai Composite up over 58% year to date. The Shenzhen up over 112% for 2015. Do you think we have some irrational exuberance here, or is it all justified?
I think after a 7-year bear market, Michelle, peaking at 2007, when you look at the Shanghai Composite, peaking at 5,000 in 2007, and then basically going into a secular decline up until last year. So it's not surprising that shares are having a major run-up or had a major run-up over the last 12 months, because over the last 7 years, before the latest run, the stock market hasn't done anything. And also when you look at valuations, when you look at what Chinese A-share earnings are in 2016, we estimate that the price to earnings ratio based on 2016 earnings is at about 17 for the CSI 300. And that's actually slightly higher than the valuation for the US stock market. And we're actually really more bullish on Chinese earnings than US earnings for next year. So I don't think there's a lot of irrational exuberance, so to speak, but I think there will be some kind of adjustment and correction. Maybe it will come today because of the disappointment over the MSCI not including the Chinese market into, or Chinese A-shares into its index.
All right, a mild correction, but still lots of room to go. Thank you so much, Henry To, Chief Investment Officer at CB Capital Advisors.